This explainer details the process for preparing financial statements for non-reporting entities. We'll be adhering strictly to the methodology outlined in the official learning guide. Now, a non-reporting entity is one that isn't required to prepare general-purpose financial reports that comply with all accounting standards. This process ensures that even without that requirement, their statements are accurate, compliant with organizational policy, and provide real clarity for decision-making. Our agenda follows the logical sequence from the learning guide. We'll begin with the purpose of financial statements. Then, we'll cover the requirements for preparing compliant statements, the critical process for reviewing and correcting errors, the procedure for getting final authorization, and we'll wrap up with how these stages combine to ensure total process integrity. All right, let's start with the foundational question. What's the primary purpose of creating financial statements in the first place? As the source material establishes, they're not just a record-keeping exercise, they are a fundamental tool for organizational governance and operational management. At their core, financial statements are the official, formal records of an organization's financial activities. The learning guide defines them very specifically as tools designed to provide useful, structured information for decision-making, both for people inside and outside the company. This slide breaks down that core purpose into 5 key functions, all outlined in the guide. The statements provide the data to help with strategic decision-making, to measure financial performance against targets, and to provide the necessary information to attract investors or secure financing. They also ensure compliance with relevant regulations and promote transparency and accountability. Now, we'll move on to the preparation phase. See, it's not enough to just list financial data. The statements have to be prepared in a highly structured format that sticks to official accounting standards and specific organizational requirements to even be considered valid. These official rules are known as accounting standards. The learning guide we're referencing really emphasizes that in Australia, the Australian Accounting Standards Board, or ASB, is the body that sets these guidelines. And their purpose is to make sure every financial report is consistent, reliable, and comparable across different organizations. The guide points to several key standards that govern different aspects of reporting. For instance, one standard dictates precisely how financial statements must be presented and organized. Another one defines the mandatory rules for the cash flow statement, while a third details how to report major physical assets. Each standard plays a specific part in creating a complete and compliant picture. So these standards give us the essential framework. We're now going to use that framework to look at the 3 core financial statements that, according to the guide, form the foundation of any complete financial report. First up is the income statement, which you might also hear called the profit and loss, or P&L statement. As the source material explains, its main function is to measure profitability. It does this by showing exactly what a business earned versus what it spent over a specific accounting period. This slide illustrates its fundamental structure. You start with all the revenue generated. You subtract all the expenses from that same period, and the resulting figure is your bottom line, either a net profit or a net loss. Simple as that. Next is the balance sheet. Now, a key difference from the income statement, which covers a period of time, is that the balance sheet is a snapshot. It's designed to present the precise financial position of an entity on one specific day. It does this through the fundamental accounting equation. It balances what the business owns, its assets, against what it owes, its liabilities. Any value left over belongs to the owners, and this is defined as equity. And finally, we have the third core document, the cash flow statement. Its purpose is to explain exactly how a company's cash and cash equivalences balance changed over a period by tracking all the cash coming in and all the cash going out. This source material specifies that this is done by breaking all cash movements into 3 distinct categories: cash flows from day-to-day operations, cash flows from investing activities, like buying assets, and cash flows from financing activities, such as getting a loan. Once the initial statements are drafted, the process isn't over. Not by a long shot. The next stage is a critical review designed to identify any errors and make sure the final documents are accurate and fully compliant with all the requirements. The learning guide points out several common pitfalls that can really undermine a report's integrity. This slide highlights 2 of the most frequent: simple data entry mistakes and misclassifying transactions. The solution is just procedural discipline, systematically double-checking all the figures and making sure you completely understand the correct accounting category for every single transaction. The list of potential errors also includes transposition errors. That's when you reverse digits, like recording 52 instead of 25. An effective review also has to check for any transactions that were left out or entered twice, timing differences where entries are put in the wrong period, and the failure to correctly calculate and apply depreciation on assets. To catch these issues, the Learning Guide outlines a systematic review process. As you can see here, it starts with a comprehensive checklist, then moves to verifying data accuracy against original source documents, reviewing the consistent application of accounting policies, and investigating any transactions that just look unusual or out of place. When an error is found, a formal correction process has to be followed. First, the error has to be identified and its impact on the overall statements assessed. Then, the correction is made, all related entries are updated, and critically, the amendment has to be fully documented and get formal approval. That final approval step brings us to the last major stage in this process, getting official verification and authorization from designated people within the organization. These individuals are known as delegated personnel. The source material defines them as the people within an organization who've been formally given the authority and responsibility to sign off on financial documents, which confirms their accuracy and compliance. To actually perform this verification, delegated personnel have to rely on original source documents. As this slide shows, they'll cross-reference the figures in the financial statements against primary records, things like invoices, bank statements, and contracts, to make sure every single figure is backed by verifiable evidence. To wrap up, let's just summarize how this entire multi-stage process, when it's implemented correctly, guarantees the integrity of an organization's financial reporting. Ultimately, the key takeaway from the Learning Guide is the answer to this very question. A rigorous system of preparation based on standards, a meticulous review for errors, and formal authorization by delegated personnel isn't just administrative paperwork. It is the fundamental process that safeguards an organization's financial health, builds trust with all its stakeholders, and ensures all reporting is transparent and fully accountable.